I hope you're all having a good weekend. This is Brandon with Crypto Trades and Tech. I haven't been able to do weekly update videos in quite a bit, just things have been busy. But want to do a quick update here. I'm supposed to go live tomorrow night, so you're going to get a little bit of a double whammy. Hopefully we can catch up a little bit. But what I wanted to talk about in a brief video update here was just my thoughts on the broad market. I've been doing a lot of research on the situation with what the Federal Reserve can do as far as raising rates, how the market's been reacting, why the market has reacted a certain way. So I just wanted to share my thoughts on all that, and then how that relates to the crypto markets and what I'm expecting to happen. But before we get started, as usual, I'm not a licensed financial advisor. If you were to take trades blindly based on things I talk about today, without doing your own research or setting up your own trades and trading according to your own system, you're going to get wrecked. You're going to moving into a van down by the river. Which the crazier things get, the better that actually sounds. So I don't know if that's a good or bad thing anymore, but nonetheless. What I've been watching here on the S&P 500 and Nasdaq is a bit of a decelerating downside, as shown in this kind of descending wedge pattern. We can see that price is decelerating, coming to the downside, and we've broken out of it. We've got some confirmation of the breakout. The question is this a full reversal, or is this a relief rally and we have another leg down ahead of us? It's my assumption at this point that this is a relief rally. I was looking at, this is the 111-day moving average. We've come right into that. So anything between the 100 and 120-day moving average is right around the range that we're in. You can see this daily resistance here at 41.51 SPX. And then if I flip to the weekly, you'll see there's a weekly resistance level. The weekly close up from back in May, and the open at the end of May that sent a strong leg down. That close was 41.69. I'm looking for resistance around there. It wouldn't shock me to see price break through and make it back to the 200-day moving average before we get some rollover. But at this point, we've had two pretty strong impulses to the upside in a fairly weak macro environment. So my expectation is at least some consolidation here, but I am expecting the markets to get exhausted on this rally and at least test support, perhaps 3,900 support. I am very much undecided as to if I think that the next down leg could really take out the prior lows, if these were going to be the lows for this impulse down, or if we're going to rotate down one more time. Of course, we look at Nasdaq, very similar story, not as clean on the resistance levels. The Nasdaq story is a little bit different because we have this weekly level right here that we broke through and closed above. So we do have some semblance of confirmation of a breakout. We did take that liquidity from that swing high back in late May. We took that out and closed actually above that as well. But we are also coming into the 100-day moving average on the Nasdaq as well. I think perhaps if the Nasdaq could run all the way up here to this weekly resistance at 1351, but we're kind of in the caution zone, I would say. I'm looking for some resistance to come into play somewhere between where we're at now and I guess on up to as high as $14,000. But it's my read that the market is thinking very similar things, that we're all thinking that the Fed can only raise rates so high before they break things because of the debt in the system. However, I think the markets are also pricing in peak inflation. So here's where my thesis, I think, varies from maybe the broad market. I think the broad market thinks that the 9.1 print is probably peak inflation. But the more I study the situation, the more I align my thoughts with Lynn Alden, especially, has been talking about the price of oil and a stronger potential probability that oil prices stay elevated for a longer period of time. We go look back here in 2014. Or 2008, I'm sorry, it really spiked really fast and rolled right over. We've been having more kind of consolidation here than a really quick rollover, more akin to this 2011 style of slow push up and then a collapse. But just the situation, there's just, when you look at the underinvestment in the space and the demand, look at the situation with natural gas in Europe, this is probably going to push inflation. If this stays elevated, it's really going to push inflation because the increased cost of goods, both in producing goods and shipping goods because of high energy prices, is going to really start to show up. There's a lag effect on that. There's also the stage 2 effects, the inflationary effects. As inflation becomes more settled in, what happens is wages have to be increased to match inflation. And then with those wage increases comes increased buying power by the consumer. So then you skew the supply demand ratio again a little bit more. So you have this long tail effect of inflation. So I think my read on the situation is that the markets are pricing in the Fed's inability to raise rates too high for too long before they break too many things. But the market is also, I think, pricing in peak inflation. So what I kind of think might happen is inflation is going to run hotter for longer, and the Fed is going to be more aggressive than the market is currently thinking, which might lead to that second leg down. But what's going to, in my opinion, ultimately happen is the Fed is going to have to either come out and say it, or just by their actions we're going to be able to tell that they're going to have to live with higher inflation than they want, their target, for a period of time. And I believe when the market catches wind of that, as the Fed is both softening and there's increased inflation, that we have a situation of both things happening, that could really be very bullish for risk on assets. We just have to get to the next 2 to 6 months, depending on how long that battle goes between the inflation number and the Fed's resolve to fight inflation. They seem pretty resolved to fight inflation. So currently, if inflation does stay sustained longer than the market, I think, is pricing in, the market will then start to, I think, react to the reality that the Fed is going to be caught between a rock and a hard spot, and they're going to have to go more to the extreme on the inflation side, push the economy into a little bit more severe of a recession than otherwise, and we're going to get that stagflationary environment. So going back to Lynn Alden's thesis, I'm going to take you to the broad SPX. I'm going to take you back to the last period. Again, I'm getting this a lot from Lynn Alden and her research, listening to her lately. But the period I think we are most likely in is something akin to the 40s wartime period. I think this whole time frame, this big move up and then this big drop, is akin to the start of COVID. There was a pretty big move up, and then we had a big drop, and then market started to recover and kind of bounced around for a while. This is where I think we're actually at. I think we're getting this kind of a relief rally, and I think this is all going to be compressed into a very short time frame. Because when you think about the effects of the war, there was the effect of the war, there was the ramp up of the industrial complex to produce military equipment and the spending that went along with that, and then consumers and producers both left to go fight the war, and men that went off to fight the war, and then the return home of those men from the war. And then you had this prolonged period of high inflation and relatively low interest rates. You can kind of see that depicted here, right? As the money printers were ramped up to finance the war, the interest rate and the debt to GDP increased drastically. The interest rate was kept really, really low through the late 40s into the early 50s, into that recovery. And then that interest rate chased the great inflation, they call it, of the 1980s. And you can see in this chart here too, you can see that debt to GDP spiked massively in World War II, and we're in a similar spike for the COVID monetary expansion and debt to GDP. So I think the playbook is very much in line, as Lynn Alden says, in the 1940s here. The best way to really get rid of this very high debt to GDP level, which is actually higher than is currently shown on the right side of this chart even, is to let inflation run hot and let the GDP grow by way of inflation, which then in theory inflates away the debt. So the issuance of funds to buy back or to repay the debt becomes less of a burden. There's less real return on the investment of those holding the debt. This is a big pain to debt holders, but given the playbook that was run in the past after World War II and that post-economic boom, I don't see any other way to get out of it. So that's not to say that it looks like there's going to be definite hyperinflation, but I can see a much higher than 2% inflation run rate for a number of years. And that brings us back to risk assets and fixed assets, right? So what type of assets do well in an inflationary or stagflationary environment? Well, gold typically does fairly well. because it's seen obviously as a hedge against inflation. Really, it's a hedge against market uncertainty these days, but it's a low inflationary store of value. Then you have other fixed assets, real estate, fine art, and now, of course, with the advent of digital money is Bitcoin. So I do think once we get through this next 2 to 6 months, it's very undecided as to how this next few months plays out. Once we get through that and the market digests that data, if we do see that playbook being run of allowing inflation, or being forced really to allow inflation to be higher than policymakers would like because of the debt load, making it impossible to increase rates, real rates, to beyond the interest rate, or the inflation rate, I should say, which would really curb inflation. If interest rates were higher, if the cost of borrowing money was higher than inflation, that would drive inflation down pretty quickly. But that's not really a feasible outcome given the debt load today. There's a lot of reasons how we got here. If you think about it, though, we've been in a very deflationary environment with globalization and technology both being highly deflationary catalysts. So we've had the advent of a lot of technological advancement, and then this globalization, supply chain globalization, that has allowed this prolonged period of monetary inflation with very low inflationary pressures. But that may be coming to an end. So the point is, fixed assets are going to have their day, but I don't know that that day is today. Generally speaking, we look historically back at Bitcoin bear markets, for example. Just Bitcoin alone, once you make this significant peak and you put in a low, you sit down at the capitulation zone for, generally speaking, a few months. And we saw in 2018 we got a little bit of a rally, and then a bit of a correction, and just a lot of sideways price action for a couple of months. Well, 2018, what was the macro market looking like? Well, we didn't have the CPI inflationary headwinds that we have today with increasing interest rates, right? So we had a more accommodative monetary policy in 2018, and this still took many months to bottom. So if we take just that historical view here, and we overlay a particularly volatile macro risk on, risk off environment where the market is probably going to swing very quickly between risk on and risk off, or relief rally and back to risk off, because of the drastic change in conditions we're going through. There's a lot of data for the market to digest. And so it's my feeling, as we look here at a potential, Bitcoin's working on a bit of a breakout of this trading range that we've been in, I would expect a relief rally. Maybe we can see here there's a confluence of things going on, resistances above us. So you've got this long-term trend line drawn from the November peak through that, we'll call it the Do Kwon Luna fueled 48K pump, which was right at the 200-day moving average, incidentally. And then the big correction that happened after that. And this is really our mass capitulation event, most likely. Peak capitulation or close to it on these forced liquidations here. Now the bounce that I would be looking for, as you saw this big sell-off here, we bounced all the way back to 200-day moving average. This particular sell-off, I could see us getting back to the 111-day moving average. There's a weekly resistance level, and then this trend line is going to come into play as we possibly get into those price levels. Look at those weekly levels real fast. This was the one, as we sold off that just murderous series of bearish weekly candles, that one attempt at a bullish candle with a long wick, a bit of an inverted hammer candle there. But then the rally off of that bullish candle was short-lived, and then back down the market went in the right around $30,000 level. So expectation would be on the very first attempt at the relief rally, or the first attempt at getting out of this bear market, we might hit the bottom of that trading range, which is right around, really, the bottom of that whole trading range is really closer to 28,000. You get up to about 28,000, maybe get up to that $30,000 level, and then get initial rejection is what I'm looking for. There's also, as Rion in our Discord channel pointed out, this weekly candle right here, this big capitulation wick candle. This is that forced liquidation candle, I'll call it. It's really what was happening through this time frame. The very top of that candle this candle right here in general has been controlling price for several weeks now. So that's also going to provide some resistance, and this could be our trading range that we stay in for a little bit longer. So we could get only to 26,000, 27,000, and then get a rejection at the top of this candle and remain price bound. I'm going to show you a similar control candle back here in 2018. You see this candle right here? This one didn't control price as much because it did get below it, but this trading range between these 2 weeks, the 2 weekly candles, gave us a pretty good trading range in there. So nonetheless, we could see price being controlled by these weekly candles, this one weekly candle, very similar to how these couple of weekly candles, there's really these 4 weekly candles, controlled price for several weeks beyond that before it broke out. And obviously, when it actually broke that, that's when it made a huge move to the upside. So going back to our current time, we have this entire candle. Now the candle body, very similarly, we had the body of these candles get closed below this control candle, but the wicks, unlike in 2018, we didn't take out the lows in this wick. But this candle could end up be our price control for that very prolonged period before our bear market breakout. So summary point is, what I'm looking to do right now is I bought some Bitcoin with outside capital at $18,000. Now I deployed all of my stable coins in a series below the 200-week moving average, which is currently, we're going to close above that on this weekly close, which is again bullish. That's good. That's at 22,800. But I did buy on this dip here. I did put in 18,000. I did layer in all the way down to 14,000, 18, 16, and $14,000. The only one that got filled was 18,000 with outside capital that I brought back in to buy this dip. I'll be looking to sell that, at least that, if not some of this that I bought below the 200-week moving average coming into this resistance here, just to de-risk. And again, if we do break to the upside, which means that we would have taken the 111 moving average, I'll be happy to buy a dip back into that support region if we do continue to move after I've sold and break out. I'll be looking to buy back. I would imagine the probabilities are that we at least retest the top end of this trading range. So you can see, interestingly enough, again, you go back to 2018, what actually happened was that bit of control, those couple of weekly candles that really controlled price, it ended up trading in the top half of the trading range, consolidating there before breaking out to the upside. So very much like that price action over there. Let me get rid of some of these levels that are making it difficult to see this weekly chart. Similar to that over there, we could hit, between Rions, I'll give them credit for the $27,000 level, we'll call it, just round up a little bit, up to that weekly resistance all the way up to $30,000, and the midpoint of that being right at the 111 moving average. We could hit this area, get an initial rejection, and trade in the top half of this trading range, which would be right above the 200-week moving average, which is again at 22,800 today. There's a pretty good possibility that we follow a similar pattern, initial rejection, and consolidate here for a number of weeks, get outside of this trend line, and then get a resumption signal back out over here, and then a big breakout. That would put us, over here in September, October for a potential breakout, which would line up nicely with a market rallying on the back of softening Fed. It seems to be consensus time that we're going to see some signs of the Fed starting to slow down those rate hikes, and the market is going to start forward pricing in the inevitable QE and rate cuts after that. So just some intel there. Levels, again, levels to be watching. Resistance somewhere between $27,000 and $30,000. The 111 is a good level to watch if you're with me on using the moving averages. It's currently at 28,480, so really right around $28,000. Should we get an initial rejection there, there's a good chance that we end up holding the midpoint of this trading range right around 22,500. That lines up well with the thesis that I'm not 100% certain we're going to take out the lows in the equity markets after our next rejection. And the same thing could happen here. You can see this pretty interesting levels. You go draw, you see this price action that cut right through here, about $3,900. There's a good chance that we get a rejection and we find support in that $3,800 to $3,900 region on the S&P 500. Similar setup here on Nasdaq. You see that the price was held right at 12,140 for a number of weeks, and then it broke through. So that could be the area that we come back to even on the Nasdaq or the S&P 500, and you get a lot of bears really screaming for a lot more downside because the Fed, don't fight the Fed and everything else, and the market is exceedingly good at getting the majority of people on the wrong side of the market. So that's currently what I expect. All right, everybody, we're going to go live tomorrow. Tomorrow, I'm going to focus more on looking at trade setups in my live session. There are some setups starting to form. I am in some active trades, actually. So I'll share what I'm doing as far as actual trading. We're going to look at the community crypto rankings that we've been doing, really giving an opportunity score to the large caps, some of our favorite small caps, and then some projects that we're doing some more research on. But this is going to be really valuable in helping at least myself, and I hope you all find this exercise valuable, of going through and looking at what potential market cap in a hype cycle could these individual projects hit based on what market they're really involved in, and then looking at the opportunity score using several different metrics, namely our risk metric, which really we're looking at the liquidity available to a project. So how easy is it to buy, and how liquid is that project, how many exchanges is it on, the team that's involved with it, technology, the activity. This is really a combination of community development, really development activity, the community, the strength of the community, how much is the community really behind and pushing that project, and then really strongly skewed toward the tokenomics. This is our number one. This gives us the biggest weight in our risk scoring, is how good are the tokenomics of an individual project. And then going through the exercise of scoring all that out, and this takes quite a bit of research to score every one of these out, we get a opportunity score based on, again, the current market cap, the potential market cap, and then that risk metric gives us our opportunity score, which really will help us to identify, for me anyway, I'm going to be using this to help identify how much of my portfolio I'm going to allocate to which projects for my longer term trend trade or position trade, long-term hodl positions. This isn't going to be as useful to me in swing trading. With swing trading, I'm simply price only. I do want to make this clear. This is for people that aren't actively swing trading, that are really trying to position trade, that are trying to DCA into good projects, buy them for the long term, and perhaps sell a little bit when it's clearly overinflated and the price is very, very high. And rinse and repeat that very long-term mindset. I do both things. Like I have a portion of my portfolio where I'm doing that with, and then I have a portion of it that I swing trade with. So for me, this is how I'm defining how much of my portfolio I'm allocating to each of these projects for a long-term position, specifically through the next hype cycle. So this is really helping me dial in, outside of Bitcoin and Ethereum, what other projects I'm going to hold for the duration of the hype cycle, and do exactly like I said. When I see that it's clearly overpriced, when there's a lot of hype behind it, the price has gone up 10, 20, 30x, then I'm going to sell some, if not the majority, and look to buy back when it's in a capitulation phase, right? So, but this scoring is going to help me really dial in my weightings of what I'm holding through this next hype cycle. So we'll talk about that tomorrow. We'll look at these projects more in depth. We'll look at trades, and I'll take Q&A from the community. But thank you all. I'm so sorry for not having been able to put out more videos lately, but I appreciate your patience. And if you want to follow me on Twitter, I'm at Crypto Jedi with a 0 and a 1 on Twitter. You can find it in the description below, in the video description. I'm more active on Twitter, and I'm most active on our free community Discord channel. So feel free to join us there. That's where you'll find me posting daily multiple updates, thoughts, any trades that I take or see, setups that I see, whether I take those trades or not. I'll post those in Discord as well. Okay, everybody, thank you so much. Take care.